Because risk impacts every activity that a bank undertakes, divisions, lines of businesses, and teams can't be left to develop their own risk management frameworks and approaches independently of other groups within a bank. Instead, risk management is developed at a strategic firm-wide level. By creating a risk management framework across the entire enterprise, senior management can develop a consistent approach to risk management aligned with the bank's long-term objectives and goals. This approach to developing a risk management framework at the enterprise level is known as Enterprise Risk Management, or ERM. And what's the objective of an ERM framework? Well, it's to ensure that a bank manages risk effectively and consistently across the entire organization. An effective ERM framework should achieve the following objectives. Promote a strong risk culture within a bank so employees at every level understand their roles and responsibilities in protecting the bank from risk. Support the bank's strategy by embedding risk considerations into the bank's planning, both day-to-day or operationally and longer-term or strategically. Develop an appropriate risk governance structure. Risk governance describes a bank's general rules and standards for risk management. Protect the bank's reputation. And comply with the laws and regulations in the jurisdictions the bank operates in. So how would a bank actually go about establishing an ERM framework? Most ERM frameworks consist of the following steps. Number 1, establish risk appetite. Number 2, identify risks. Number 3, assess risks. Number 4, respond to risks. And number 5, monitor risks. An ERM framework is iterative, meaning once the process is completed, it starts again. So, let's look at these steps in a little more detail. All companies, including banks, has capital that's been provided by the shareholders of the business. If the bank makes a profit, it will probably pay some of this profit to the shareholders as a dividend, as a reward for providing the capital. The rest of the profit, well, this will be added to the existing capital. If a bank makes a loss, this is absorbed by the capital, which is effectively reducing the amount of capital the shareholders have in the bank. However, because of the capital buffer, the bank is able to continue operating as usual. If this capital buffer is totally wiped out, however, the bank faces a very real threat of becoming insolvent and failing. When a bank takes more risk, it has the chance to make higher returns for their shareholders. However, it also increases the chance of losing a lot of money, putting its entire capital buffer in danger of being wiped out. This capital buffer a bank has is finite and limits the amount of risk a bank can take. This limit is the bank's risk capacity. A bank that exceeds its risk capacity could see its entire capital buffer wiped out if things go really wrong. Once a bank knows its risk capacity, it can define its risk appetite, which is the amount of risk they are prepared to take on over a given time period. Determining risk appetite is all about deciding which risks are acceptable and which risks are not. Risk appetite is not a single fixed concept. It can be different for different risks, as well as different for the same risks at different times. A bank may decide that business conditions are good and the economy is about to experience a period of growth. The bank may decide to increase its risk appetite and take on more risk in the hope of generating extra revenues while times are good. Or a bank may decide that business conditions are not good. For example, if a bank is predicting a recession in the coming year, they may decide to reduce its risk appetite and take on less risk. By doing so, a bank is making a conscious decision to limit potential losses in order to protect its capital. The Enterprise Risk Committee, the committee with oversight of the ERM framework, helps the senior leadership of the bank to determine its risk appetite. You can probably see it's a careful balancing act. If the bank takes on too much risk and future losses are more significant than expected, capital is wiped out and the bank could become insolvent. On the other hand, if the bank takes too little risk, it's likely to generate less revenue and income than it would otherwise, resulting in financial underperformance. Risk identification is the foundation of risk management in an ERM framework. A bank can only manage risk once that risk has been identified. Identifying risks is an ongoing process as employees and risk managers go about their day-to-day tasks. A formal identification process, however, often happens on an annual basis. So, what tools do banks use to identify risks? Internal audits can identify risks. Internal audits find weaknesses and vulnerabilities in a bank's processes, corporate governance, and operations. An internal loss is a loss incurred by a bank due to risky events, so analysis of internal loss data can highlight risks. Risk Control Self-Assessments, or RCSAs, are usually surveys or workshops a bank runs where staff and management identify risks and associated controls. Key Risk Indicators, or KRIs, are metrics that are used to assess and measure how risky an activity is. Scenario analysis is where expert opinions from lines of businesses and risk managers identify potential risk events and their potential outcomes. While in a stress test, the bank runs computer scenarios to measure the impact on the bank's capital should a variety of unlikely but very extreme events materialize. Every single identified risk is recorded in a bank's risk register, which also records what response the bank intends to take towards these risks. The response is determined once a risk assessment has been made, which is what we will explore next. Following a comprehensive risk identification process, the next step in an effective ERM framework is to assess all the risks recorded in the risk register. Risk assessment is necessary in order to determine an appropriate response to risk. Within an ERM framework, risk assessment has 4 stages. Number 1. A bank needs to develop assessment criteria to be used by all business areas so that risks can be assessed consistently across the enterprise. 2. A bank assesses risks on a standalone basis by ranking risks based on the assessment criteria. 3. A bank assesses how risks interact with each other. Risks that seem minor in isolation can combine to cause considerable damage. Number 4. Risks then need to be prioritized. It's easier for a bank to assess how much risk appetite it has for a risk event once risks are ranked relative to each other. What is actually assessed at this stage is how likely a risk is to occur and its impact on the enterprise if it does occur. Let's look at these 2 dimensions separately. Likelihood is the probability that a risky event will occur within an enterprise within a given time period. The higher the likelihood, the more frequently that risky event will materialize within the organization. Banks will assign a rating scale, typically using both quantitative and qualitative descriptions, measuring the likelihood of occurrence. Here's a simple illustrative example. An event that may only happen once every 10 to 25 years is considered a rare event. It has a very low likelihood of occurring, and so it has a very low rating. At the other end of the scale, an event that may happen once every couple of years is considered a very frequent event, and so these events are given the highest possible rating of 4. Here's another illustrative example. This time, the definition is using a quantitative scale. In this example, an event that may only have a 10% likelihood of occurring over a given time period perhaps 2 years, might mean a bank considers that event a rare event, and so it assigns it a low rating of 1. If, however, a risky event is deemed to have a 75% likelihood of occurring over the same time period, a bank might consider it to be almost certain to happen over that time period, so it assigns it a high rating of 4. In practice, a bank will typically use a combination of quantitative and qualitative descriptions when assessing the likelihood of a risky event occurring. What do we mean by impact? Impact describes how much consequence a risk event will have on the enterprise should it occur. Some risks will have a low impact, meaning they will not materially harm the bank even if they occur. For example, a customer defaults on their credit card payment. Some risk events can have a huge impact. For example, a rogue trader ignoring internal controls. The losses and fines this could lead to can cause a very material loss to the bank. There are several criteria a bank will use to assess impact. Some criteria are financial and some are non-financial. Here are some examples of how a risk event could impact a bank. A bank could suffer a financial loss due to a risk occurring. For example, Akega's Capital defaulted on loans made to it by Credit Suisse, resulting in losses of $5.5 billion to the Swiss bank. A bank could experience a loss of capital, increasing the risk of becoming insolvent. Back in 2008, the Royal Bank of Scotland undertook a £12 billion rights issue, the largest in British corporate history, to increase its capital after losses during the 2008 global financial crisis. A bank could incur fines and/or lawsuits. For example, Spanish bank Santander was fined £108 million in 2022 by British regulators due to anti-money laundering failures. A bank may have restrictions placed on it. Back in 2018, Wells Fargo had restrictions placed on it by US regulators after widespread consumer abuses. A bank could suffer damage to its reputation. For example, negative media coverage following the LIBOR rate rigging scandal in 2012 damaged the reputation of several well-known global banks, such as Deutsche Bank, UBS, and Rabobank. A bank will use an impact rating scale to quantify the impact of a risky event on the bank. Some risky events have a financial impact on the bank, while other risky events will have a non-financial impact on the bank. As such, any scale will use a combination of financial and non-financial impacts. Let's look at an example. In this example, the impact rating scale ranges from 1 for risky events with very low impact through to 4 that describes risky events that will have a very high impact on the bank should they materialize. Under the definition column, we can see the various types of financial and non-financial impacts risky events can have on the bank. These could be financial losses. They could generate negative media attention, harming the reputation of the bank. They could mean that the bank is reported to the local regulator, or they could result in the bank losing market share. What would we do if a risk has characteristics relating to more than one level? Well, an effective ERM framework will classify the risk in the highest scale it reaches. An enterprise needs to decide on an appropriate response to the risks they have previously identified and assessed. If the risk has a high impact on the bank may choose to avoid that risk. This response could be appropriate when there is zero risk appetite for it. During COVID-19, many banks and companies in other industries decided to avoid the risk of their employees getting sick by introducing work-from-home policies. A bank can take steps to reduce either the likelihood or impact of a risk event. If the risk is above a bank's particular risk appetite, but still wants to accept some exposure to this risk, reducing risk could be an appropriate response. For example, a bank could use artificial intelligence to scan and analyze internal data to reduce the risk of being a victim of financial fraud and still carry out business in that area. There is still a chance that the bank may be a victim of fraud, but using AI has reduced the risk to a more acceptable level. Risk transfer is the scenario where a bank moves responsibility of the risk to a third party. Transferring risk does not reduce the likelihood or impact of an event, but means the bank is protected from any negative impact of that risk. Hedging is an example of risk transfer. Banks often use derivative contracts to hedge and transfer risks from financial market transactions they are involved with. Finally, banks need to decide which risks they choose to accept. For example, a bank that decides to lend money to a customer has accepted the credit risk associated with this transaction. Banks have to accept some risk to some acceptable level, and often it makes sense to accept a $100,000 risk than spend $200,000 avoiding the risk. Some risks are more acceptable to accept than others. A risk with a low likelihood of occurring or a low impact is more acceptable than a risk with a high likelihood of occurring or having a significant impact. Through its ERM framework, a bank has identified and assessed the risks that it's exposed to and has decided on an appropriate response to those risks to avoid, reduce, transfer, or accept risks. These steps are completed after a bank determines its risk appetite, ensuring accepted risks do not exceed the bank's total risk capacity. Now a bank needs to monitor risks. An effective monitoring process should assure senior management and the board of directors that existing risk controls are in place and employees within the enterprise are following these controls. Risk monitoring is a critical stage of the ERM framework. There are several reasons for this. Risks are dynamic and can change quickly. Without proper monitoring, the previous steps of identifying, assessing, and responding to risk would be pointless. Risk monitoring collects up-to-date information on risk that can be incorporated into the ERM framework. Risk monitoring allows senior leadership to act appropriately if and when the risk nature, potential impact, or likelihood exceeds the bank's appetite for that risk. Any changes in the likelihood or impact of a risk should be updated in the bank's risk register. Related to monitoring risk is the process of reviewing risk. Reviewing risk answers another question: what are the new emerging risks? New risks must be analysed according to their likelihood and impact and recorded in the risk register.